Well, welcome to our Young Investors Society and Global Investment Symposium today. Thank you all for being here. I love to see all your guys' faces every week. We're so excited to have you today. I have a couple of things before we get started. I just wanted to let you know. So after each speaker, there'll be a couple of minutes for questions and answers from you guys. So if you guys have a question, type it in the chat. I'll select you and unmute you so you can ask your question. And then after that, we'll go back on mute. And then there'll also be a couple of chances for you guys to answer some trivia questions. So that should be fun. So we're going to do a little bit of trivia. Again, type your answer in the chat, and whoever is first to type their answer in the chat, I'll get your email address and we'll send you a stockpile gift card. How does that sound? Awesome. All right, you guys. So I'm going to give it over to James Fletcher. As you know, James Fletcher is the founder of Young Investor Society. Excited to have him here today along with our guest speakers. So I will give it over to James.
Well, thanks everyone, and it's wonderful to see your faces. I would like to thank Christine, the YIS board, for all of their work that they've put into this event. I would like to thank our speakers who have, we have an amazing lineup scheduled to teach us today. And so my heartfelt thanks to Young Investor Society, Christine, and all of our instructors today. Today's goal is simple. So you requested that we do a roundtable with experts in different industries. And I think what you'll see today is that we have some of the leaders in all different aspects of finance. You'll learn about impact investing. You'll learn about networking and building a career in asset management. You'll learn about AI and fintech. You'll learn about investing in the stock market, and it should be a fantastic program today. We have just, I would say, 3 goals for you by way of introduction. So the first goal is just to have fun. The second goal is to learn something. So you're here to have fun, you're here to learn something. And then the third goal, let me start with a story. The third goal is to find a spark. So when I was 8 years old, I still remember my grandpa was a scientist, and but he had this passion for investing on the side. So he pulled me on his lap, and one day we were over at his house, and he pulled out the Wall Street Journal, and he showed me the stock section, and he said, look at the stocks going up and down. And I still remember that day. I remember going back the next Saturday and saying, Grandpa, can you teach me about stocks again? And he pulled out his investment brokerage account, and he said, James, here's what I'm investing in, and why I'm investing in it. And even all these years later, I still remember that spark that I felt of, this is fun, this is exciting, this is something that is competitive and I can learn about. And as I went through my life and going into finance and going into investing, and my career has been, a fun, tremendous career, I will never forget those earliest moments, that earliest spark that I had sitting on my grandpa's lap and him teaching me about stocks and the Wall Street Journal. So the third challenge that we would have for each of you today is to find a spark, find something that you hear today that inspires you, whether it's something about university, whether it's something about career, whether it's something about investing. To find that spark. And so those are my introductory remarks. I will share our first trivia question. So as Christine said, the first one to write the right answer in the chat will receive a $25 stockpile gift card. And we'll be doing 9 of these throughout the evening tonight. So are you ready for the first question? The first one to type in the chat, the right answer wins $25 to stockpile to start investing. Okay, first question. What company rose 696% in 2020? So find the chat function, and the first to write it is the winner. It looks like it was Romir Mohan with Tesla was the correct answer. So well done, Romir. Christine will be in touch and you will win your gift card. So we'll be doing those throughout the evening. It should be a fun way to mix it up. So without further ado, I would like to introduce our incredible first guest speaker. So Craig Shell joined Bain Capital, the Double Impact Fund, as the managing director in 2016. Prior to joining, Greg served as the lead portfolio manager of the Concentrated Global Equity Fund at GMO, which, as many of our listeners know, is one of the largest funds in the world. Previously, he was strategy and private equity practice at Bain Capital, at Bain & Company. Greg earned his MBA from Harvard Business School and received his Bachelor's of Science from MIT. Greg, I turn the time over to you, and thank you so much for your time today.
No, thank you, James. And let me give a special thank you to my friend Bielka. I don't see her, but I think she's on. There she is. I see you, for inviting me this evening. I have 15 minutes to talk to you and then 5 for questions. I'm going to try to stay within that. But I do want to say, what James mentioned in terms of finding that spark is something that I want to pick up on. Unlike James, I really discovered that spark later in my life. It really wasn't until college that I had heard of investing at all. But boy, once I found that spark, I've never let it go. And I want to share that to you today. One of the things that interests me about investing, one of the many things, is how deceptively simple it really is. And once you sort of uncover a handful of rules of the road and apply those faithfully and consistently, they never fail you. I think the entirety of the activity that we all see on TV all the time and increasingly in chat rooms and so forth almost purely distract you from the very simple concepts that once applied are pretty well guaranteed to make you more well off than you were before. I want to share a few of those with you. The first thing that I want to say is that as young people, I just want to applaud you for your commitment to this topic. Here it is a Friday night when you could be playing Xbox or doing, whatever else. And here you are thinking about investing. It's something that I was not doing at your age and stage. But I want to maybe submit this idea to you, how far ahead of the game you already are, and to give you some confidence to keep going. There are 3 things that really matter in terms of your ability to build wealth through time. The first one of them is, of course, the amount of money you start with. For me, it wasn't a big amount, but if I were to be good at saving, I could put money away that I worked for and apply that. The second vector is really the return profile. It's better to make 10% than 5, and it's better to make 696% than 10. So investing with skill and with information and knowledge, is something that you should always aspire to. And then the vector that will matter the most for you all is the vector of time. And I'll talk about the theory of compounding in a little bit. But don't underestimate how even small acts this early part of your life will continue to build to be something that is truly surprising as you go on. Now, many of you would know, if you asked somebody who's the most famous investor who ever lived, many of you would probably say somebody like Warren Buffett, and for good reason. He's been an exceptional investor over a long period of time. But when I look at those 3 things, the amount of money that he started with, he probably was ahead of most. He was probably above average. Has he gotten really great returns? Absolutely, he has. But if you think about what he really has achieved in his life, it's the fact that he's been compounding money for 80 years. And it turns out that almost anything at any rate of compounding growth, compounded for 80 years, grows to be something much, much larger than when it started. And as young people, you have a tremendous advantage to begin to compound your wealth at this early stage. So here's what matters about investing. The first thing that I discovered about investing was what it meant to think and act like an owner, producer, creator, as opposed to a consumer. I began to look at all of the economic activity that I saw and thought of if what it would be if I stood on one side of a line buying any product. It could be groceries, it could be sneakers, it could be a phone, and being charged a markup and a profit margin for someone else to enjoy versus what it meant to do the work as an owner and to be the person charging, that same markup or profit margin. And think about if I lived my life on one side of the line, mostly, or the other. And I started to realize, even when I'm working at work today, I'm not just working for my firm, I'm really working for myself. And so all of your time, your energy, your skill, your effort, what you learn at school is really helping to build you into something who works for him or herself, period and full stop. And I think once you do that, you start to value your time very differently. You start to look at something, it's snowing in Boston today. You start to look at that as an opportunity to say, who's not, in position to or doesn't want to shovel their snow? I feel like I can do that. I'll take the half an hour that it takes and pocket that, $5, $10, $50, whatever it is. And I think the first thing is to be able to put yourself in a position to work and save money, invest it so that that money can work for you as opposed to you working for it. That's the first thing. I think the second thing about investing, and this cannot be overstated, it is attractive to pursue significant outsized gains like you saw with Tesla. Problem is, they're exceedingly rare, much more rare than you think empirically. And number two, they often happen when you have to reach for additional risk. And it's interesting when people say things like more risk, more return. It's the opposite. More risk, it's the higher likelihood that you experience capital loss. So you actually don't want to be risk seeking. You want to find things that are mispriced that you don't have to take a lot of risk to make money. Why does this matter so much? And this took me later in my career to really understand the math behind this, that gains help you less than losses hurt you. Let's take $1 and let's say, what happens when you grow it by 10%? You get $1.10. What happens when you shrink the $1.10 by 10%? You don't get back to $1. You have something less than $1. You have 99 cents. What happens if you go the other way? You take $1 and you shrink it by 10%. What do you have? You have 90 cents. And what happens if you grow that 90 cents by 10%? You get 99%. So imagine a world where something went up and down and up and down and up and down at the same magnitude. All of a sudden, over many periods, your capital base has continued to be ground down. Volatility and negative returns are bad for your portfolio. You much rather be somebody who can compound even modest gains, but positive gains all of the time. So this first rule of investing is not to lose money. And the second rule is always to not forget the first rule. Losses hurt you more than gains help you, even when they're at the same magnitude. The third thing that I wanted to say is compounding is the most powerful mathematic force in the universe. And the reason why it's so magical is because we as human beings don't understand logarithmic math. We really understand linear math. So if I said, what is $1 compounded at 10%, over 15 years, it's really, you start to lose, track of how to think about that. And that's why I said Warren Buffett is successful, not just because he was smarter than others, and not just because he knew what to do with his money more than other people did. In fact, in many years, he looked pretty average. But when you compound things for 80 years, it really, really matters. When you have a large amount growing quickly and for long periods of time, that is the magic formula to how to amass wealth. I also almost always, when I'm talking to especially elementary age kids, I use the penny game to illustrate compounding. And I say, if I gave you a penny, on January the 1st, and I doubled it every day for a month, what would I have at the end of the month? So 1 cent becomes 2 cents, becomes 4 cents, becomes 8 cents. And what do you have at the end of 31 days? And routinely people say things like 45 cents or $8 or $100. No one ever guesses $10.7 million. No one ever guesses that. And the reason is because in the first week, not a lot happens. Even in the second week, you have a modest amount of money. But in the last 4 or 5 days, the wealth accumulation of something doubling every day becomes really violent and violently positive. And how do you know this? Because if you counted backwards, it would be much more intuitive to you, right? At the end of the period, you'd have 10.7, but 1 day sooner, you had half of that number. 1 day sooner than that, you had a fourth of that number. 1 day sooner than that, you had an eighth. So in the early periods, you have something that looks like, you can't see my hand, you have something that looks not very much. And then all of a sudden it goes like this, really, really quickly. Compounding capital is just like that. Save your pennies and nickels and dimes and dollars, put them away into things that are growing, and do that repeatedly forever. And you will be my age, which I'm probably older than you think, and you will have a surprising amount of money if you continue to add. I have a goddaughter. She just turned 13 yesterday. I told her that for Christmas, she's going to get a fancy gift from me. I love her so much. On her birthday, however, I'm always going to contribute to her investment account. And it's going to grow, and it's inspired her to save more, and her parents now, add to it with regularity. So before she ever graduates from high school, she's going to have, a certain amount of money, but importantly, she's going to have built up habits that we think will accrue to her forever. The fourth lesson that I want to give you is that investment skill, knowledge, and the positive investment behaviors that people exhibit are demonstrated by a shockingly small amount of people. That discipline and that success in investing is not widespread, and it's not equally weighted amongst people. I would want you to self-select your way into mimicking the behaviors of the people who know how to do this and demonstrate it consistently in your life, in their lives. I think that's true amongst your friends and peers and contemporaries. It's certainly true in the world of business. I want you to read relentlessly and put yourself in position to learn from people who are giving you good counsel. That does not mean figure out who made the most money in a given year. It does not mean who came out with the latest whiz-bang product that could go away every year, but people who honor the time-tested rules of what it means to amass wealth and get to know those principles. They sound a certain way when I'm talking to you about them, but lots of people have talked about them in compelling ways as well. Get to know those people, listen to them, embody that discipline, and share that with people who are in your lives. And you'll start to notice that people who you see at the grocery store, at the barbershop, wherever, you'll start to pick out behaviors that you'd say, I want to emulate that. And I definitely don't want to emulate that. Get to know that, get to be the kind of conscious price shopper, get to be, somebody who appreciates the value of $1 and the value of an hour of your time. But the people who tend to win a lot, and the people who lose, unfortunately, lose almost all the time. And it's because of the behavior that they exhibit. And it's on you to accumulate the knowledge and the discipline that you can flex day in and day out in your lives. And then the final thing, for all of the excitement about using one security, as a ticket to wealth building, it mostly doesn't happen like that unless you're an entrepreneur who has a concentrated position. But most of the rest of us are diversified. We have a portfolio of options that are always working for us. And that way you don't assume too much risk of any one thing going too right or too wrong. But always the portfolio is kind of growing, kind of there. Some years you have fabulous years. There will be some years where you lose some money. But if you're always adding to it and it's always diversified and protected, you will tend to make money over a period of time. Those things, there are some we'll call it subreddits, in terms of these rules. I would want you to buy low-priced, products as opposed to high-priced products, for example. There's some detail around those things. But those things about being an owner, creator, producer in your life, at least in your mentality, and not just a consumer, understanding what it means to not lose money and protect your capital, and how positive gains of the same magnitude help you less than that same magnitude of losses. So don't lose money. Third, the theory of compounding and the idea that your money starts to grow logarithmically and not linear. Follow the right people in your life and embody the things that they do. And then finally, have a diversified portfolio. If you do those 5 things, you will always have an ever expanding opportunity to generate wealth in your life. It took me, I've been in the investment business for 25 years. It took me a long time to learn a couple of those lessons, but once I learned them, I've never forgotten them. And I can tell you that by embodying those lessons, I'm able to open up a world that in many ways I was not bold enough to dream when I was your age. I've had a very fulfilling career, one that is very satisfying and gives me opportunities in my life, and I get to share those things with friends, and I'm empowered to help people in ways that are important to me as well. So those are my comments for now. I'd love to open up the floor for some questions, and I think we'll take our 5 minutes, and I'll give way to your other amazing speakers.
Perfect. Thanks so much, Greg. I have Eliana who has a question for you.
Yes, thank you. This is Toby. So I had a question. I wanted to thank you, number one, for speaking about those subjects, because I really appreciate it. And not only are those great investment tips, but also life advice. So thank you. My question is about, you talked a lot about compounding interest. And of course, I'm a firm believer that that is the number one key. But I'm also wondering what type of account is suitable for that. Because currently I have a custodial account because I'm not 18, which is limiting because they tax you continuously, and it's really hard to build wealth when it's in that manner.
Ileana, I can't tell you how happy that makes me that as someone who's not yet 18 is thinking about tax advantaged ways to build wealth on a Friday night. That's so amazing. What I would tell you, there are a couple things. The world is dramatically different today than when I entered the business. It was expensive to invest. It was an insider's game. It probably still is, but in a much different way. The opportunity to invest at really low cost and the democratization of information about investing, this information is widely available in ways that it just wasn't 20 years ago, and definitely not 50 years ago. So I'd be a little bit more sensitive today, about the nature of the things you're doing with the money as opposed to the account type. A custodial account does not prevent you from compounding depending on how it's invested. So to the extent that it offers you some tax advantages, that's a really good thing. I do think it will be important for your own independence going forward, but also for the flexibility. If that account limits you to what you can invest in, to have an account that allows you some broad flexibility to buy funds of different types, for example, and easily accepts new money without a lot of friction and bureaucracy. I think there will be a day where if you do all of that right, you will have a private banking account, I would imagine, and it'll open up a lot more product types and flexibility. But for right now, at the stage that you're at, Eliana, I'm pleased for you to have an account at all, and for you to be in position to continue to see money go in it, and to have increasing opinions and views about the things that are being invested in, and your ability to have a voice in that, to say, no, I don't want to be as heavy on this asset class. I want to lighten up there, and I want to be in something else. For you to have a convicted view that's informed by something, that's the magic right there. And I think that is what is going to hold you in good stead, not whether the Disney stock that you hold, is at one price or another. It will be the habits that you embody for the rest of your life.
Wonderful. Thank you so much. I really appreciate it.
Excellent. I have Jack who has a question for you.
Hi, I just wanted to say that, thank you for speaking, and your career has been so inspiring, it seems. So I wanted to ask you what some of your favorite investments have been over your career.
Man, that's like choosing between children. I've had so many, interesting experiences, Jacques. I've invested in probably, many, 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 many dozens of securities over a lifetime, and probably, a handful of billions of dollars, of assets against those. Um, the things that I like, without naming, individual stocks, I would tell you, one of the things that I think I'm best at, frankly, is being able to hold a convicted opinion even when the crowd is against me. And that's something that I've always prized about how I've approached this career, is when you've done the work and you feel that you're right. Often the best returns come to the people who are earliest to an insight or had the most courage to act on their conviction. It's so much more comfortable and convenient to be part of a crowd and to be wrong than it is to be on the edges and to be right. And that's a place where I have tried to make my career, which is to do the thing that others were not doing. And I can tell you, it gets really lonely when you are in that position, but there's nothing more gratifying in the investment career to be early to something and be right. And I would add to that perspective, Jacques, the idea that not only do you want to be right, because this is not a game, you also have been entrusted with this sacred responsibility to manage other people's money. I always connected my work every day to the fact that somebody on the other side of what I did that day was going to have more or less wealth. They were going to retire a day or sooner or a day later, or so I felt. And so I felt this deep responsibility to be a caretaker. They've hired me, and my time is not cheap, in that way. They've hired me and spent real money to get the benefit of my investment skill. So I'm not out here, nor should any of us be out here just risk seeking to try to find some way to, multiply that money by 10. Sometimes it is just the small purposeful acts of doing things that others aren't yet willing to do that put you in position to offer the best value proposition to your clients and to yourself. But yes, I do have a sort of hall of fame of stocks that I've, where I just crushed it. And also there have been times where I've been hurt so bad that I had to go to bed at 7 p.m. because I couldn't stand it to be still Thursday, and needed to just have it be, a new day. And I would tell you that there's only one way to learn, about this business, and that's to make mistakes. And the idea is you hope your wins are big and your mistakes are small. But for people who've never lost money or never lost, who've never been through an economic cycle, do not put your money with them. They have not learned enough. And this GameStop saga is a perfect example of that. When that's your lesson, and that's your hymnal that you read from about how to invest, you cannot manage my money. You just haven't seen enough about how these things can go wrong. And I fortunately, have made enough mistakes in this business to correct them and learn from them. And I'll make more mistakes in the future, but not the same ones that I've made. Is there one more before I yield to the next speaker?
Greg, I think that's all for now. I'm going to give it over to James.
Excellent. V, thank you so much for the invite.
Yeah, amazing job. Okay, so next, let's do a trivia question. So actually, we have 2 trivia questions. So same as last time. Type it in the chat. Name the investor that ran Fidelity's Magellan Mutual Fund between 1977 and 1990, averaging a 29.2% annual return. So find that, type that in the chat. The first one to get the right answer looks like John O'Neill. So the correct answer is Peter Lynch. Peter Lynch is the legendary investor from Fidelity that averaged 29% annual return per year at Fidelity's mutual fund. Okay, so John, Christine will be in touch and you'll get your $25 stockpile. Let's do one more. Name a special retirement account where you pay taxes on money going into your account, and then all future withdrawals are tax-free. You guys are so sharp. Amazing. Okay, so Jasper Lau was the first one to write Roth IRA with a question mark, but he still wrote it. So we'll take that as his final answer. So Jasper, congratulations. The correct answer is a Roth IRA. Wonderful. So with that, it is my honor to introduce Grace Reyes. Grace is the CEO of the Investment Diversity Exchange, or known as TIDE, which connects and engages movers and shakers and promotes diversity and inclusion within the investment industry. She's also a director of the nonprofit organization, the Asian American Multi-Technology Association, the AMA, and an independent board director and part of the Audit Committee and Professional Diversity Network, so the IPDN. Grace earned a BA degree in economics with computer specialization from UCLA and an MBA from UC Berkeley. I have really been looking forward to this presentation from Grace. Grace seems to know everyone in the financial community and is just such a voice of optimism and engagement within the investment industry. So Grace, it's such an honor to have you, and I turn the time over to you.
Thank you guys so much for this opportunity. Thank you to Young Investor Society and to James for the honor to speak today. And I'm excited to spend this time with you because I know in a short amount of time, what I will share with you is valuable information that can boost not only your career, but also your day-to-day life. And I'm sharing this because throughout the years, many of my friends and colleagues have complimented me about my ability to connect with people. And the more I hear it, the more I realize that what comes naturally to me probably doesn't come naturally to some people. And so the good news is that you don't have to be natural at it. For example, like athletes, right? Athletes, there are some that are very talented and they have natural abilities. But then there are some that are really good because they practice and they work hard at it. So regardless if you're natural at making connections or it's not your strength, I'm confident that you'll learn a thing or two today that will help you level up and get ahead. And so now, why is building connections important in the world of investing? Unless you're investing your own money, you're going to have to work with investors. And when you create meaningful connections with investors, they like you. And guess what? Investors invest in people they like. Of course, the other part of this equation is having a good track record and products to invest in. But today I'll focus on making meaningful connections. And here are 5 tips. Number 1 is to add value. When you're adding value to someone's life, they want to connect with you. In the book by Adam Grant called Give and Take, it shows how some people rise to the top of the success ladder because they are givers instead of takers. Think of it this way. When someone has the hookup to something you like, don't you want to be connected to them? Another example of adding value is sharing your knowledge or being of resource. And I know the students are listening and they're like, Grace, well, how can I add value when I don't have that much to offer yet? And so I was exactly in your shoes. And I'll share with you one sentence that has helped me much, even until today. And that is whenever I reach out to ask for something and I know I have nothing to offer in return, I would always include this sentence. And it's, I hope someday I can be of resource to you as well. That tells the person that you're not just a taker, but you want to give back. Which leads me to my second point. Be sincere and genuine. It's important to keep it real and stay authentic. When you say something, be sure you follow through. Don't just say it because it sounds good. Otherwise, you're just manipulating to get what you want. If you're authentic, people can feel it, they can sense it, so their guards are down and you're able to connect at a deeper level. One way my company connects and engages the investment industry is through events. And a friend of mine who also hosts events, she said to me, Grace, when I host these events, these investors are very formal and uptight, but when you host events, they let loose and they're so much fun. And that's because I connect with them at a deeper level, more than just a professional level. For me, they're my friends. Even if I didn't work in the investment industry, I still would be friends with the people that I work with. And so number 3, connect with people who can add value to them. So the cool thing about making meaningful connections is that even if you yourself can't add value at that time, you can connect people to others who are valuable to them. Being a connector is like a puzzle. Find out what connections a person can benefit from and connect them. So professionally, I've connected funds to very valuable investor contacts. And if you position yourself as a hub with all these connections, you'll attract many people. And from there, you can pick and choose who you want to associate with and deepen your connections. And now you're wondering, how can you build connections when I only know a handful of people? That leads me to my next point, host events. Like, look at this one, right? So COVID has amplified the need and desire to have human connections. We're social creatures. So you could host an event that has a common thread so that people who attend can find some way to connect through common interests. And when you're hosting an event, make sure you introduce someone in the best light possible. I saw this in action early on when my mom would host parties, and she would introduce someone by finding something that she truly admires about that person. And I can see that person light up and appreciate it. And sometimes I catch people doing it to me and I know what they're doing and I like it. And so just be sincere and genuine about it. So then again, you're like, Grace, I don't know that many people to host an event. Well, it doesn't have to be big. It could be 1 or 2 people. Invite them out for coffee. And by the way, as you grow older, if you invite someone for coffee, be courteous enough to pay for it because they're giving you your time. And before you meet with them, look for common interests on LinkedIn or social media and bring that up when you're speaking with them. And to scale your efforts to make meaningful connection, I'll leave you with my last tip, and that's to collaborate. Early in my career, I had to find a way to efficiently network because I was and still am raising a son on my own. And I don't know if you saw someone run earlier, that was him in the background. And so I knew that networking and going out and meeting people were important to helping me succeed in my career, but I couldn't go out every single night. That's when I decided to host a happy hour for finance professionals. I called it Good Times SF because everyone has a good time. And it has become San Francisco's largest investment happy hour. And that's because I partnered with like-minded women who were well-connected, and collaborating has helped me scale my efforts to connect with people. If you meet someone through another person that they like, it's a warm introduction, and it's much easier to connect because they already like you by association. So those are my 5 tips on how to make meaningful connections. To sum it up, making meaningful connections is like investing. And like how Greg mentioned earlier, how compounding is how Warren Buffett has made his fortune. So the same way, the more you invest, the more dividends you'll receive. And in the same vein, investing in meaningful connections will pay dividends in the future. Hope you enjoyed the session as much as I enjoyed preparing it for you.
Great, thank you so much, Grace. I have Manar who has a question for you.
Hi, Manar.
Oh, she's still muted.
Your story is really inspiring, and it teaches us how connections can really matter in this field. So my question is, How do you think experienced people can benefit from people who are, although new in a certain field, but are still being genuine and authentic?
Usually people that are experienced, like for instance, James, right? He does this, he helps you out because he's already risen to the top and he wants to give back. So there are a lot of professionals that, are doing it out of the goodness of their heart. And yeah, I think for the most part, when you're young and they know you're young, they're most willing to help. And the fact that you're even offering to give back, I think that shows, that just shows initiative and they're even more eager to help.
Excellent. So Grace, I have Rima who has a question for you as well.
Hi, Rima.
Hey, Grace. I just wanted to say thank you for speaking. I think more than like direct, like very direct advice on what we can do, like starting out for investing, like making connections and like networking at this age is what's really important, because that's what's going to help you like further on. So my question was, I'm working on a project right now with one of my classmates, and I asked one of the professors of surgery to collaborate, and he's a professor of surgery in a university that's not close to me, so I can't like meet with him directly. I think the only way we can like quote unquote meet is like through Zoom meetings right now, or like through any online like chatting service. So what's your advice for making a meaningful connection going forward when you're virtual like this?
So I must say that in person is always the best. And at this time though, I would always ask the person, do you prefer Zoom or do you prefer a regular phone call? So sometimes there's Zoom fatigue, right?
Right.
But preferably, again, in person or then a Zoom meeting. I would just say a Zoom meeting would be the most efficient way. But again, he's a surgeon, he has limited time. So I would send out the list of questions in advance and anything that you could do to prepare him. So that way, when he's on the phone with you, you're already set. He knows the agenda, he knows the questions, and it's an efficient way to have the meeting.
Thank you so much.
No problem.
Excellent, great advice. Grace, I have Eliana who has a question for you.
Hi, Eliana.
Hello. Thank you for talking about networking and investing. I really appreciate your time, and I think it's awesome to learn about that. So I had a question about young people who do networking. I'm not a huge fan when I see people try to manipulate people. Oh, I want to, what's your medical practice? Oh, it sounds so cool. Let me get to know you. It's so obvious to me what they're doing, and it just shows me that they don't care about the person whose money they're trying to take. So do you, from your experience, think that people automatically dislike younger people when they try to do that?
No, I think the people that you're hearing are not authentic and genuine. Again, if you're coming from a place of curiosity and interest, they could feel that. They'll know, and they can instantly read. So I think there might be those people that are like that are fake, and we could sense it. But when we know, like, all the questions you guys are asking me, like, I know you guys are real. So yeah, we'd be more than happy to help you guys out in that case.
Amazing. Thank you so much.
Excellent. Thanks so much, Grace. I'm going to hand it over to James.
Thank you.
Grace, thank you so much. That was amazing. Amazing presentation. Thank you for being on. Okay, so let's do a trivia question and then we'll have our next speaker. So you guys know the drill. Trivia question number 4. Benjamin Graham, the father of value investing and the author of The Intelligent Investor, was a longtime professor at what esteemed university? So write that in the chat. And
that was fast.
First one to get it. Let's see. Okay, we had a couple different answers, so it looks like we're getting a little tougher now. Princeton, Yale. The correct answer was Columbia.
Have
So,
Luke.
and Warren Buffett actually met Benjamin Graham at Columbia, and that's where he developed his value investing philosophy. So Luke was the winner. So Luke, congratulations, $25, stockpile gift card to start investing. We have one more question, Columbia University. One more question for this round. Who was the first shark of ABC Shark Tank to host an interview with a YIS student? So this is a history question about Young Investor Society. All right. So we have lots of answers. Eliana, you wrote Mark. You can unmute yourself. Did you mean Mark Cuban?
Sorry. Yes, I did. I apologize. Normally, I always refer to adults by their last name, but I needed to get the answer in. It was too much anxiety.
All right. Eliana, we will give it to you. Mark Cuban was the first shark to interview Young Investor Society students. And we've had Barbara Corcoran and Damon John just 2 weeks ago. Okay, so let's move on to our next incredible speaker today. Jeff Garcia is an equity investment analyst at Capital Group with research responsibility for consumer discretionary staples, financials, healthcare, and information technology sectors in Latin America, as well as the small mid-cap companies in the US as a generalist. Jeff began his career at Capital as a participant in the Associates program, a 2-year series of work assignments in various areas of the organization. He holds a bachelor degree in management science and engineering from Stanford University. On a personal note, Jeff is one of the smartest investors that I've met. He's also one of the best people and stories. So we are privileged to hear from Jeff Garcia today. So Jeff, I turn the time over to you. Thanks for being with us on a Friday night.
Thanks so much, James. Can y'all hear me okay? Good. So great to see you, and thanks for the kind intro, and thanks for inviting me to this space. It's always a sincere pleasure to just connect with YIS folks, and I want to thank all of you. Thanks to all the students for taking the interest. The fun trivia is great, and it's just an amazing platform for y'all to get a head step. I'm super impressed for all of you for taking ownership and taking this step, and please shine through with questions and curiosity. I'll try to limit my remarks up front, drop a couple nuggets for you, but I'm happy to take Q&A wherever there's interest. So in terms of preparing to invest in the stock market, and actually maybe I'll talk a little bit about where I work just so you have context. Capital Group is a multinational active asset manager. It's about 90 years old, based in Los Angeles, which is where I'm based and where I grew up. So I'm really lucky that I can hang out with my folks on the weekends. It's a company that manages a little over $2 trillion, invests in companies and bonds and all sorts of great securities throughout the world. And I've just been so privileged, and everything that I'm sharing that is insightful, if it is insightful at all, effectively comes from spending 10 years at Capital, where I've been my whole career, and I'm super lucky to have that framework. So I want to share one big thing, and then maybe a bunch of little things right after. In terms of thinking about stocks and picking stocks and getting ready for the process, the big thing is just understand how businesses work, okay? What does this mean? I'll explain it to you, but the most fundamental part, I think, about being an investor, also I think the most fun part, is trying to figure out any individual business. It could be a stock, it could be a company issuing debt, but how does it work? What do they do? How do they grow? What is the mechanism of them growing more services or sales and making money, and what do they do? It's a whole cycle, and it's a process that all of us as investors spend all of our time trying to understand, because that's where you can develop insight. I see something in the future, it doesn't look like the world is paying attention to it. So how the business works, I'll spend a few minutes just talking about 4 really important things. This is a framework that I use all the time. And hopefully there's something helpful for y'all as you prepare and you start thinking about stocks you might want to invest in. So the 4 things for understanding how business work are: understand demand, understand supply, understand earnings visibility, and the last one is return on capital. You'll probably hear a lot of return on capital returns if you just start digging around the internet or looking at great insights from instructors, and that's ultimately one of the things most investors really care about. But you need the first 3 in order to have a really good view of what return on capital means. And if you have a sense of that, that's how you can understand the prospects of a company. So going back to the first one, demand, I'm sure y'all are informed already, but my take on it is when you're looking at a company, and it can be a legacy company like General Motors or Ford, it can be Zoom Video, the company, it could be Facebook, it can be Coca-Cola, like any company you want. What you really want to understand is, what is the potential opportunity set for this business? Where is Coke right now, and where could they be in the year 2025 or 2026? Where is Facebook right now, and where could they be in terms of users, in terms of how they generate more revenue? And the cool thing is that you can look up, type in any publicly listed company and investor relations and get all sorts of cool information about what are those revenue drivers at a company. But you want to just think through, what is the real opportunity for this business in the industry it's in? Is the industry and the growth of the company, is it something that's driven by cyclical economic movements, or is it a company that can grow whether there's a recession, whether there's a bull market, whether there's a lot of positive economic activity? Not all businesses are alike, and some of them are very, very exposed to the cycle, industrial cycles, the economic cycle. And if unemployment goes up, then it's probably going to be hard to sell more cars, at least for a period of time. And so reading the cycle is really important for understanding demand. And then on the flip side, right, like a company like Snap or say Google or say Amazon, I mean, those might be agnostic from the cycle, and they might just be doing something very cool, interesting, novel in the world in the best way possible. And in those cases, the cycle might be less pertinent, but you want to identify what kind of demand matters for this business, for any individual company. On supply, which is the second point, the main thing about supply for me is, what is the architecture of this industry, right? Is it a monopoly? Is it a highly competitive business? I really like coffee. I tell my wife all the time, like Sunday, I'd like to have a coffee shop. But you know what? It's probably going to be really, really competitive, because you got companies like Starbucks and Coffee Bean, and a couple other really big players that have, if you think of just the pie chart of market share, those two probably have the biggest slices, and I would be this tiny sliver trying to just make it. And in that case, competition is really high. And that means that, coffee supplied, say in Los Angeles, there are a lot of really cool sliver coffee shops here. So it'd be really tough for me to have a go. And that matters, right? That matters for a business in terms of where do they fit in the supply of the product or service that they're in. Facebook is an example where, hey, in the social media industry, they are so dominant, right? They have Instagram and Messenger and a lot of other cool properties, and they've basically dominated, social media from profile, information sharing, picture sharing, et cetera, for a long time, and it's pretty hard for someone else to come in. And so if you have a company that's in a market architecture or a demand a supply landscape where they have the biggest share, it might be them and another, Coke and Pepsi, that's probably really good. That gives you pricing power, that gives you a little bit more ability to grow your business, whether there's a big cycle or not. The third thing is, if you put those two things together, just think about the earnings of a company and the profit, right? If you have a sense of how much they'll grow because of the demand outlook that you have for the company, and you have a sense for whether it's competitive or not competitive, that gives you a good way of saying, what could revenue be like for this company? What would be the cost of goods and the operating expenses? And that gives you a pretty helpful, simplified way of mapping out earnings. And if you think something is going to be drastically exciting for revenue and it's going to grow a lot, and you read, Seeking Alpha reports on the company, and people aren't as excited as you, whether it's Snap or Nike or Starbucks or Peloton or any of these companies, that tells you something, right? And that probably means that earnings are going to be really high for that business. And then on the flip side, if you were doing an analysis on Jeff's Coffee, someday you might see it in LA, it's probably going to be really hard for me to make a name for myself because of the supply dynamics. It's probably going to take a lot of costs or marketing for me to even start being relevant. And my earnings probably will not be all that great, at least in the first few years. And that's, these are, I'm trying to give y'all just kind of the most important ways to understand how can the financial profile of a company or the business that I want to look at, how can that change over time? So, the last one, which is return on capital, this one's, it takes a little bit of reading to probably have a grasp on what does capital mean for a company. If it's Starbucks, it's all of the money they're putting in to open new stores, to refurbish stores. Maybe it's money that they're doing to develop cool new coffees. Maybe it's money that they're using to update their tech infrastructure and their app, and they're making long-term investments in that. But for any business, whether you're a big listed company that has a stock or a corner lemonade stand, what you do with your earnings after you've paid your expenses for doing business, you have some money left over, your earnings net margin could be 10% or 20%, or maybe -5% when you start. But if you have money left over, how are you investing those earnings so that your company and your business can keep growing 5, 10 and more years down the line? So you put all those things together, and that's a pretty representative snapshot of at least how I spend my time. There's all sorts of vocabulary and techniques, of course, and everybody can kind of dive in at their own the pace that they want to get those mechanics down. We can obviously talk about accounting and what does it mean to recognize revenue, or is an investment in your business CapEx or OpEx and all sorts of stuff. But that basic framework has always guided me in meeting hundreds of companies each year and having a lot of fun just understanding how a business works. It's that curiosity about how does this thing work? How does this company work? How do the people that run it make decisions? And what can the future look like, that I love about investing? And I offer that framework for you all as you think about picking stocks for yourselves. So that's the main thing I wanted to share. And really quickly, I'll just rifle off a few points to keep in mind as you go through the process. Point one is there are experienced folks out there. YIS has a great platform, and it has connections with people that can teach all a lot. And there's great investors that have published a lot in the world. My favorite, my most instructive, learn from the pros, has been just reading the Warren Buffett annual newsletter. You can, pull them off the internet. You could, get a simplified version on Amazon. But if you read his newsletters over several decades, I mean, in one sitting and one set of reading, you can just navigate the economy and the history and the trends, and those annual reviews from really bright people, Bill Gates has them, other great investors have them. There's wonderful literature out there for you to just learn from the pros, right? And it's always been a helpful part of my experience as I've learned about stocks. The second thing I want to share is just also be mindful of the landscape when you're investing in stocks, right? There are some stocks that are racy and move fast, like Tesla and Amazon last year. And there's other stocks that are sturdy, whether it's like CSX, a railroad company, or maybe more sturdy grocery stores. The way that bonds move in the market and drive returns, all of those different types of investments, and how they're distinguished from what happens in venture capital and the pre-IPO markets and the flow of IPO. Understanding that landscape of how different companies take investors is one good way to connect with stuff you might read in the news about what's going on with the market as you start picking apart what happens in stocks. And the last thing I'll say is just start, really, like pick 5 companies, maybe 10, somewhere in that zone, businesses that you either interact with a lot or that you have a lot of interest and want to learn about, and just have that small list of companies and start digging into how they work, and the mechanics of it all flow through there. So I will pause there. Really appreciate you guys having me here, and really appreciate everybody's attention.
Excellent. Thanks so much, Jeff. I do have a question from one of our students, Pratik.
Hi, thank you so much for providing your insight on a lot of the fundamentals of how you go through evaluating a company on the market and all of that. I took a course over the summer in which I learned about some fundamentals of investing, and I was wondering how effective you thought ratio analysis was in terms of comparing companies within the industries. So if you were to compare like Tesla to I don't know, like CCIV, if Lucid Motors ever comes on the market, but like stuff as that, how effective do you think ratio analysis is in those cases?
Great question. I think it's hugely helpful. I mean, it's a very good way to frame that market architecture part I was talking about. Like, just you want to know, and the best thing is having, if you have different stocks that are listed and you have financials from different companies, you can compare them, and without a ton of work, you can pretty quickly see, wow, this company tends to have a higher return on capital or return on equity. This company has a negative return. Like, you can see that range of how good or bad any company is because you have that peer set. So I think it's a wonderful way to like understand the backdrop of this company I'm studying. I think the catch with it is, with investing, you're always thinking about the future, right? And so you want to start framing like, how could this, once you have your first map of, say, ratios that help you compare different companies, then you got to start thinking like, how could this picture change? How could one of these really low returning companies turn it around? And that's when, maybe you go and you listen to the last 4 or 8 quarterly reports. This is also a fun investment thing for me. Like, if you just print out the last 2 or 3 years of quarterly reports and you just read the first few paragraphs or the first couple of pages and you hear the CEO, and you do that all at once, you get a pretty good feel just in their language and their highlights of the business for how the business is shaping up, how optimistic they are. And you have to, this is one of the ways that you might start thinking, how could the future look differently, right? Some CEOs might be really aggressive and they might want to take on Tesla. Maybe you're General Motors and you say, hey, we're going to be all electric in 5 years, right? That will be different. Maybe there's a CEO change. Like, I think that, the main idea is just always come back to how could this change? What are the main drivers in the future? But I think it's a wonderful way to frame and kind of anchor, that snapshot when you're getting going on understanding a company and the competitors it might have.
Great. Thanks, Jeff. I think we have time for one more question. Jesus.
Hello, thank you so much for your presentation. I wanted to ask you, when you started investing, how did you decide how you were going to diversify your portfolio? Did you focus on more growth stocks, defensive stocks, cyclical, or etc.?
Great question. I had no clue, right? I joined out of college. Like, I'm just super lucky. Like, Capital took a chance on me, and it was all about process, right? Investment process for evaluating the companies. All I knew is, I feel like I really like basketball, so I'll use a basketball analogy. Like, I am totally in the JV league here. Like, I'm on this championship team, but I've been given this responsibility. So what I'm going to do is just play as many games as possible, right? I'm going to go out and try to meet 150 or 200 companies in a year. The next year, try to meet another 200. So for me, the process was all about reps and meeting a lot of different businesses. And even before I had a very consistent framework, I knew just from meeting them, understanding how management worked, I could tell when I felt like there was something there, right? And it's a combination of intuition and information. So basically, once I did that process, I've tended to focus on special companies, champions, basically companies that have total dominance in their sector, whether it's e-commerce or fintech, or it could be a consumer company, but just the companies that are, if you make that pie chart, have the biggest slice and are going to grow the slice. Like, for me, that is the thing that I really like to look for, and that makes a difference. So what that means, to answer your question most directly, I do like companies that can grow better than a lot of people think, can grow in a durable way for many, many years. And at the same time, I also want companies that understand how to make money, because you can't just grow by, just marketing a bunch forever, right? That runs out, you will run out of money eventually. So there are companies that recognize, hey, we're in an industry that's so early that we're going to grow. E-commerce is probably the best example. Is we're going to grow our users, grow the sellers that sell stuff on our platform. And if we become the biggest provider and the biggest place for people to come shop, that's going to give us a chance to monetize our users in many different ways down the line, right? And so depending on the maturity of the industry, that will drive, growth focus versus profit focus. So I like companies that understand how to grow, understand where the future's going, and are doing it in an economically sustainable way.
Thank you so much.
Excellent. Thanks so much, Jeff. I'm going to head it back over to James, who has some more trivia for us.
Jeff, thank you so much. And I hope all of our listeners were taking notes. You were getting expert training from Jeff and from Capital Group, which is as good of insights as you could get on how to pick stocks and how to invest. So Jeff, that was amazing. Thank you so much.
Thanks, James. So great to see you. Good to see you, Jane. Really love everything you're doing here, and let me know however I can be helpful anytime.
You're amazing. All right. On to more trivia. Let's just give me 1 second here. Okay, here we go. Okay, so same as last time, put it in the chat. A measure of return a mutual fund manager produced relative to the risk he or she took to earn that return. So the questions are getting a little harder. Who knows? Who can guess the answer? A measure of return a mutual fund manager produced relative to the risk that he or she took. All right. The correct answer was Sharpe ratio. So congratulations, John O'Neill. That was a hard one. I wasn't sure anyone was going to get that one, but you got it right away. Well done. So Sharpe ratio is the answer. And one more question. A type of machine learning based on artificial neural networks in which multiple layers of processing are used to extract progressively higher level features from data. So this is to set us in the mood for our next speaker, who will speak to us on AI and fintech trends.
James, can you forward the slide to the question?
Sorry, what was that?
Can you forward the slide to the next question?
Yes. Is it not forwarded?
No, we're still on Jeff Garcia.
Oh, interesting. Let me try again.
There it is.
Okay. See it now. Okay, you have the answer. So the answer is machine learning. So congratulations. Let's see who won that one. Ooh, we didn't have a machine learning. We had deep learning. My fault. Okay, so no one earns that one, but we will learn about AI and fintech from Professor Lee now. So without further, Eliana, you can't get the $25 now. Without further ado, let me introduce my friend and incredible professor, David Lee from the Hong Kong University. So this was actually perhaps the most requested session from the students was to have a class on fintech and AI and new trends, blockchain, cryptocurrency in our symposium. So I reached out to Professor Lee, who is at the University of Hong Kong Business School. He's active in areas of ethics, fintech, leadership, and governance. David also co-teaches the first of its kind, a massive online open course titled Fintech Ethics and Risks, which has registered over 12,000 students and received a number of recognitions and awards. David started his career at Goldman Sachs and received his undergraduate education from Brigham Young University, graduate degrees from Harvard, London School of Economics, and legal training at the UCLA School of Law. So without further ado, I hand the time over to Professor Lee.
Hey, thanks, James. I appreciate it. I'm just gonna share my slides real quick. I'm not gonna rely on them too much. You don't need to write anything down. I'll drop a copy of the slides into the chat at the end, so everything will be there for you. You know, we'll talk through it. But I'm just gonna use the slides as kind of placeholders and to highlight a few different things. So I guess two things I wanted to start off with. One, I see one of my former students on this chat. So Leon, good to see you. And then secondly, I'm gonna probably try to run through this as quick as possible. You know, the topic scope was quite broad. So even trying to cover it in 20 minutes was not gonna do it service. So what I'm gonna try to do is cover some just key points, maybe like in 10 minutes. And then I'd love to spend the remaining 10 minutes just chatting with all of you. And I'd be happy to discuss, answer any questions. A lot of this area is so unsettled still. I mean, there's no quote unquote right answers. So I think it'd be great to hear what all of you think as well. So let me just share my screen here. And hopefully everybody can see it. So let's see here. There we go. All right. So let's just run through this quickly. So that's intro stuff. Okay. So first question is, what is fintech? I'm sure this is a buzz phrase that all of you have heard about. This is just an interesting graphic that shows some aspects of different fintech verticals. But basically, you know, it's traditional finance that is trying to be improved or optimized through the application of technology. And you know, the word fintech kind of has become a buzzword the last few years, but you know, if you really take that same definition, it's existed for a while. You know, if you go back to maybe your parents or your grandparents' generation when they first got an ATM, you know, the ability to pull cash out of a machine and not have to go to the physical branch of a bank. You know, in some respects, that is very much a technological solution to try to improve financial services. So, you know, that's kind of a broad definition. The phrase that I think is more interesting and I think will be more relevant for all of you as you think about technology and finance, increasingly you see a lot, well, let me do two things. Increasingly, you see a lot of schools, for example, so some of you are in university, some of you are in secondary school, some of you are beyond that, but increasingly you see a lot of these verticals where like, hey, you can major in finance or you can study fintech. And what's gonna happen in the next, you know, few years, generation or so, is that the idea that somehow fintech is separate from finance is going to merge. Those are not going to be two separate disciplines anymore. So when you go to school or when you go off to university and let's say you decide to major in finance because you were inspired by James and YIS, you know, you should naturally, curriculum will evolve to include more technology. And so there'll be a merging of this. You know, 20 years ago or 30 years ago when the tech boom first started and Silicon Valley kind of got put on the map, you know, people used to say, "Hell, let's go study e-commerce. That'll be a degree." But now you go to a business school and e-commerce is just business, right? And so this is what's going to happen with finance and technology. Now, the second thing that I wanted to focus on was this phrase tech fin, which maybe some of you haven't heard of, but I think is important. And it's this idea of large technology companies now moving into finance. So maybe the best example of this is Apple, using Apple Pay, now having Apple credit cards. Increasingly, the ability for large technology companies like Amazon, like Apple, like Google, to use that user base and that data to then create financial solutions or opportunities for the company as well as for the customers is going to increase. And where we see that a lot, and for any of you that have spent time in Asia, where you see that a lot is in different chat, social messaging apps that exist in Asia. So in Korea, there's something called Kakao, which is a very popular, basically the population of South Korea is like 50 million, but there's over 50 million accounts of this Kakao chat, which basically means it's completely dominating the market in Korea as a messaging app. But off the back of that population, they launched a digital bank. And you see kind of similar trends in China as well. So for WeChat and other large Chinese technology companies, once they build up a base of users, oftentimes you see them moving into financial services, either payments, shopping, asset management, so being able to invest money. So be aware of that as well, because that's going to be a huge trend as all of you evolve in your careers, this idea of technology companies moving more into finance. Now, blockchain, I'm pretty sure most of you have heard of this, so I'm not going to go into too much of this. Again, you don't need to read the graphic. I'm going to drop the slides in. But the simplest form of this is it's a form of electronic record keeping. So it's a distributed ledger. So there's like a ledger back in the old days was like a series of basically notebooks. And the reason it's distributed is an electronic notebook that sits on multiple computers in a particular network, right? So it's a collection of records that are linked through this network. We say it's unalterable because it's protected by high rates of cryptography. So basically, a single bad actor in most distributed ledgers or blockchain technologies won't be able to change the record. And it's transparent because everybody in the network can see what's going on. Now, the reason that's important, and where would you use kind of a blockchain technology? Well, anywhere you want to keep track of something. So if you want to keep track of, I need to send a payment to James, or he needs to send money to me, you could do that via the blockchain. And or if you want to keep track of the supply chain. So an example, a lot of large companies like Walmart, for example, are increasingly using blockchain to keep track of products in their supply chain. And so anytime you want to keep track of things, or voting, for example, you could theoretically use blockchain. But basically, anytime you want to use a record or keep a record of something, you could apply blockchain technology to that. Now, the key thing here, which I think at least I would imagine, particularly in the last few months, that have piqued most people's interest is this idea of cryptocurrency. And that's a byproduct of blockchain. And so, kind of the original one was Bitcoin. That was kind of the first mover. And this idea was, in this distributed network, to add a block onto your network, onto this chain of records, you had to do these very complicated math problems. And the computers, or the owners of the computers that did these complicated math problems to allow additions to the block got rewarded with coin. And in this case, for Bitcoin, they got rewarded with Bitcoin. And so this is how blockchain and cryptocurrencies are linked. And I'm pretty sure most of you are at least vaguely familiar with that. So let me take a pause here. I just want to ask, maybe by show of hands, I guess, I don't know if that's possible in the settings right now, but just a show of hands and reactions, how many of you are invested in cryptocurrency? Luke, Jack, let's see, let me see. Or if you can access the reactions, yeah, Rima. So there's a number of you who are. So that's interesting. So Luke, if I can put you on the spot, or you can just reply in chat, what are you invested in?
I own some Bitcoin.
Okay, and has that been a recent acquisition, or was that an earlier acquisition?
I bought around 19K.
Okay, that's been nice for you then. And so, so let's go back. I'm just gonna pop the screen up. And so, but this is important to think about in the context of Young Investor Society, because there is a lot of debate around, is Bitcoin or just cryptocurrencies in general, is it investing or speculating? And so on the left side, you see Jack's investment in Bitcoin over here. That's the price chart for Bitcoin. And so, Bitcoin as a cryptocurrency has been around since roughly mid 2010. So it's basically been around a little over a decade. But as you can see, for most of that period, at least half of that, it was pretty flat, right? And then, you saw a little spike, and then obviously in the last few months, a huge spike, and where it's upwards of $50,000 now per coin. So for Jack's investment, or Luke's investment, has done well. Now, on the other hand, so you see this Dogecoin, which has been in the news a lot lately. And you know, if you look at these coins, particularly Dogecoin, you know, it really doesn't have a use case, right? And so that's why when you see this price chart here, it's less than 1 cent for a long time, right? Or around 1 cent for a long time. And then based on you know, kind of a facetious tweet by Elon Musk, you had some price action and price movement here. But you know, the idea is Bitcoin or investing in cryptocurrencies in general, is that investing or speculating? And I think the easiest way for me to describe it is, if you invest in a stock, let's say a good company, so like what Jeff was talking about, you find a champion company in its industry, and for whatever reasons that company goes to zero on its share price, even though, you know, it's doing business, it has some assets, etc. Chances are there is still a lot of intrinsic value in that company, assuming it's not completely bankrupt, assuming it's not completely levered up. But chances are there's still a lot of intrinsic value, and the price of the shares just don't reflect that value yet. So this is very, you know, classic kind of Warren Buffett value investing type of thinking. And I know with James and YIS, you know, we spend a lot of time thinking about what value is. You know, with cryptocurrency, on the other hand, it's very difficult to identify value in that traditional sense, which then creates, you know, kind of issues of should you think of it as a security? Now, certainly it trades. A lot of the way cryptocurrencies trade are based on technical analysis, which is carried over from trading securities. But you know, as you think about where the value lies, it's a very different type of proposition. So, for example, most of serious people in cryptocurrency wouldn't consider Dogecoin a legitimate currency that you would want to put money in, right? And so it's important to think about, particularly if you decide to go into cryptocurrency in some way, to think, hey, what is the use case for this particular coin and the underlying technology that it represents? Because, you know, we think about what we talked about for Bitcoin, you have the blockchain, which does have a very legitimate use case. And then you think about the particular coin, in this case, Bitcoin, and what is its use case. Now, it's a first mover, so it dominates the market at the moment. But you know, that may not always be the case either. So anyways, this is just a way to think about it as you think about value through that value paradigm. I think this is the kind of, I'll just share 1 or 2 more slides and that'll be it, and I'll take some questions. Now, all of these things, there are negative externalities associated even with Bitcoin. So for example, this is an interesting chart that BBC put in an article that was done by research at Cambridge University. But if Bitcoin was its own country, it would be one of the top 30 or so energy users in the world. So it would consume Bitcoin mining. So all the computers that go into checking and doing all the math problems to add things to blocks, it consumes a lot of electricity and causes a lot of environmental problems in different places. So I think that's one, you know, side effect of that. So it's important to kind of think of fintech and cryptocurrencies in general kind of holistically. This is just some AI data. You can look at it later. I'll drop the slides in. Maybe the only thing I'll point out here is in this chart on the bottom side here, this is just a series of acquisitions by large tech companies in the United States who are acquiring AI startups. So Google, Apple, Facebook, etc., are really gearing up their AI capabilities. And some of that is through internal development, but a lot of times it's through external acquisition. The last slide I want to share before I take any questions is this is a quote from Alan Kay, who is kind of the grandfather of laptop computers and kind of tablet computing that we have. And he has this great quote. He says, "The best way to predict the future is to invent it." And the reason I like to share that particularly with students, either my university students that I teach or with a lot of YIS age students, is to think about what your future would potentially look like in a context of more technology. And that doesn't necessarily mean you have to become a computer scientist. But what I would say is, if you ever find yourself in a job where your job is to basically act like a robot, then your job is probably going to get automized at some point, or it's going to get taken out by technology. And that's already happening. So how do you kind of add value in a society or global economy that is more and more pushing towards these advanced technologies? Well, one, you become very good at things uniquely that are human. So for example, becoming a great communicator. That's going to be super important, right? Secondly, get your basics down. So all this stuff, I was like super impressed. James was like doing the trivia about the Sharpe ratio, and I had to like think about that because I haven't thought about Sharpe ratio in a long time. But getting the basics down of the domain that you want to be in is super important. And then thirdly, even though you don't have to become a computer scientist or anything like that, I do think it's helpful to pick up some technical skills. For a lot of these technological verticals, the idea of data is important. And if you think about data, then the idea of statistics becomes important. So if you can get a good foundation in understanding statistics, even if you don't go into coding, I think that will be super beneficial as well. Just as a note, so there's a list of resources here about artificial intelligence, crypto, Bitcoin, etc. So, if any of that is helpful, please use it. And like I said, I'll drop it into chat actually right now. And I'd be happy to take any questions for the remainder of the time we have.
Excellent. Thanks so much, David. David, I have Pranay who wants to know, how can we use artificial intelligence and machine learning to find both short-term and long-term investments?
Okay, so hold on. I'm just trying to drop that file. So let's say, Pranay, how do you use artificial intelligence to find short-term and long-term investments? Well, that's being used right now. So if we take a step back, there is a form of artificial intelligence that's called narrow artificial intelligence. So it's artificial intelligence or artificial intelligence type tools used for specific tasks. So perhaps the easiest example to think about that is occasionally in the news, particularly pre-COVID and things like that, you would see like, oh, AI beat a chess champion. AI beat some kind of complicated game champion. Those are examples of narrow task type of AI, right? Or weak AI. And so it's a type of artificial intelligence that's tasked to just do a specific thing. And those kind of tools are already employed a lot with in finance. So for like execution trading, that's used a lot by large market makers and certain banks, as well as a variety of technologically oriented investment firms. So you could use large data sets to screen companies and make predictions based on the data that you're using. Now, at the heart of all of this is the idea that data is kind of the analogy that's often used is for any of these advanced technologies, particularly in finance, but even beyond that, the idea is that data is being used as the fuel for this technology. So if you have like a car that has, is operating on battery power or gasoline or whatever, that's the fuel. Similarly, the data is kind of the fuel for these solutions as well. So the more data you have, in theory, the better your model becomes. And then you could shape the parameters in that model to identify investment opportunities. And again, there are a lot of firms employ various aspects of this right now.
Excellent, thanks. I have another question from Ryan.
Yep.
Hi, David. Thank you for taking your time out of the day to speak to us today. I really appreciate it. I was curious how you think quantum computers will impact AI in the future and when we might start to see quantum computer technology implemented into AI.
Yeah, so that's a great question. So quantum computing is somewhat like the holy grail of or one aspect of kind of the next frontier. So people think once we get to the position where quantum computing becomes much more available, right? Then we'll be able to kind of get through to the next iteration of how this technology works. And also the big risk for quantum computing is a lot of people feel that if quantum computing becomes as developed and implemented as we think, then a lot of the current cybersecurity and cryptography that we have could easily become obsolete, which is also kind of the downside of it. So then you could see things kind of, a risk that would exist because of that. So I don't have any prediction about when quantum computing will become implemented more in in finance. I mean, if you look at artificial intelligence research, like, the people who research and write about this and have been doing it for, even over like close to a century. I mean, people have been talking about this. People have made predictions. Some people would say like 2 decades, some people say 5 decades, some people say within a century, and they're always wrong inevitably. So I'm wrong enough already a lot in my own life. So I don't know if I want to make a prediction now, but I would say I think you're on to that. If that's an area that you're interested in, certainly like understanding more about quantum computing and the opportunities that it possesses will be super helpful. But also realizing that probably initially it will be nation state actors so basically countries like the US or like China that will benefit the most at a national level from quantum computing before it gets kind of filtered down into finance or just us as individual users. And that's always been the case for technology, including the internet, which started off as kind of military research basically.
Excellent. I have one last question from Luke.
Hi, Mr. Lee. I appreciate you taking the time to speak to us today. First, I appreciate your advice to gain competency in data and statistics. I'm also wondering though about AI and ML. People often like emphasize like how important they'll be in the future, but I'm wondering like how you would recommend sort of learning more about it and gaining competency in those as well.
Yeah, so that's great. And so what Luke is referring to when he says ML is a machine learning, which some people consider. And so actually one of the charts, like I think on page 8, I believe, of the slides that I'll either send through, because I don't think I can drop them into the chat, but I'll send through to Christine and James and they can circulate it. Talks about like kind of the difference between artificial intelligence, AI, machine learning, etc. So there's a little kind of Venn diagram looking thing that kind of just describes it shortly. So you can look at that. But the underlying understanding, I guess, when it comes particularly to machine learning is this idea of data. And then what we were talking about, this data, how it ties into understanding statistics and math, and then how that's represented in programming. Basically, this is kind of the chain, right? And so for if you are trying to improve your ability to be in that space, there's a few ways to access it. I would say the easiest way, particularly if you don't want to become a computer scientist per se, but just want to be understanding and be good at data, is again like looking at statistics and so trying to get the basics of statistics down. And then the typical languages, like statistics languages that are used right now for people in this space, tend to be Python or R. So those are 2 statistical programming languages. But they're intuitive enough where most people can learn them. Right? I was on a chat like this, I don't know, a day like a week ago, where there's a guy who was running his own investment firm, and he was maybe like in his mid-60s, and he was saying how he was learning Python right now. And so I think, and the nice thing is there's a lot of online material related to Python and R already, like on YouTube, that you can just access for free if you haven't already. So that's where I would start. So again, like building up basic statistics knowledge, which is going to be helpful anyways if you want to be in finance. Like any business school that if you decide to study business, if you go off to university, you're going to have to take 1 or 2 statistics classes anyways. If you decide to do the CFA later, you're going to have some statistics knowledge anyways. So getting that base is important. One thing I always wish, like now looking back, I always wish I had taken more statistics, because you should just think of statistics as like math in real life. Like, you know what I mean? So that's important. But then based on that, if you get one of these basic programming languages that are oftentimes used in, kind of machine learning, like Python or R, like I think that'll set you up pretty well as a foundation. And a quick way to check that is if you Google like data scientists, what's required, and just look at job descriptions. Oftentimes they'll say, hey, you've got to know Python, you've got to know R. And so that's a good way to filter it.
All right. Do we have any last questions from David? I knew this would be a very popular topic. All right, David, thank you so much for taking the time. He is an award-winning teacher at Hong Kong University, and we're so grateful for his time today. That was amazing. Thank you, David.
Thanks.
All right, let's do another trivia question. Let's see here. All right, which Chinese company has risen 1,756% in the past 10 years and is now worth nearly $1 trillion? So write that in the chat. This is to prepare you for my thoughts. As you know, I'm based in Hong Kong and invest in the China market. So this is to get those juices flowing for Asia.
Wow,
Which Chinese?
fast.
All right, let's see if we have the answers. We have a couple 10 cents and a couple Alibabas. The winner is Mehul Singh. It's 10 cents. So Alibaba is close at their heels, but the largest company is Tencent, which owns the WeChat platform. And so there you go. There's Tencent. Okay, so here's a background of me. I think you all know me. I'm a fund manager. I'm also the founder of Young Investor Society, and this is an honor to be here with you. You know, we've been going a long time, and this has been wonderful. Let me just open it up to you. This is your time, and I'm happy to help however I can. You can write in the chat, would you rather sort of do light career advice and question and answer? Or would you rather see the main points of my presentation, which is how to find companies to invest in and some tips to finding investment ideas? Maybe write in the chat, would you rather do sort of Q&A career advice or finding companies to invest in? All right, looks like the presentation is the winner. You guys are overachievers and you want to learn it. Okay, so I will share my presentation. I gave this presentation to a couple of colleges actually. So this is, and this contains some of the secret sauce, I would say, of that I have learned over the years. It's a common question I get, which is, how do I find stocks to invest in? Many of you are preparing your stock pitch reports right now. And so this is a timely topic. So I'll go through some slides quickly and other slides in more detail, and then we'll open it up to question and answers. So, okay, background of me. So 3 principles to keep in mind. And you've heard these principles in your YIS classes before, but the first one is stocks follow earnings. So over the long run, stocks will follow earnings. The second point is, in the short term, the market is a voting machine. In the long run, it's a weighing machine. So this is Benjamin Graham, Warren Buffett's mentor. What does that mean? It means that in the short term, things can become driven by sentiment and trend, but in the long run, you can have confidence that it will follow fundamentals. And then the third one, if you want returns different than the market, you need to think differently. You need an edge. You need a different of opinion. We tell young investors, right? We tell all of you, if you want 9-10% returns per year, which we heard Greg talk about, that compound interest, that's great. I mean, that is powerful. For most of us, the right way to invest is just to get that 9-10% in S&P 500. But if you want different returns, you need to do something differently. Okay, so 3 slides to walk you through that principle number 1, that stocks follow earnings. So look at Costco.
Costco is, as we know, a great retailer. The stock price of Costco has followed since 1994. It's gone up 25 times. It's a 25 bagger. It's been an incredible stock. It has followed the growth of the profits of the business. As Costco's opened more stores, as there's been more demand for Costco, that share price has continued to rise. So that is just such a clear example of how what drives stocks like Costco in the long run. But let's look at another example. So Cisco was the most valuable company in the world in 2000. And this looks at the PE ratio and the stock price and the operating income of Cisco. What happened is the market way overpaid. So you were paying 150 times PE ratio for Cisco. And even though over the long run, you can see the bars, the profits continued to grow, if you massively overpay for your profits, then the stock has basically done nothing for the 20 years that followed Cisco. So that's the second thing to keep in mind. Yes, stocks follow earnings, but you can't massively overpay for earnings. Otherwise, it takes you 20 years to catch up. And then the third example, this is perhaps the clearest, best example, is look at Bed Bath & Beyond. Bed Bath & Beyond on a PE ratio has looked cheap for 10 years because it's at about 8 times PE ratio. And all the investors looking for a bargain were buying Bed Bath & Beyond. But the stock price followed earnings, and the market was right that earnings were going down and that Amazon was going to take more of its business. And one of the clearest pictures you'll ever see is that stocks follow earnings going up and going down. So you need to get that future earnings right, and that's why we talk about moats. That's why Jeff talked about growth and demand and supply of the products, because if you can get those right, then you'll get where the stock price is going. Okay, so here's a question for you. Let's take it to sports terms. How would you evaluate whether to trade for a basketball player and what price you would pay? So, LeBron James, let's say you have an opportunity as the manager of a basketball team. How would you decide what price you would pay for LeBron James? Any questions? So any comments from the group? Oh, okay. So unmute yourself and comment how you would decide how much to pay for a basketball player.
Do me a favor, raise your hand and I'll unmute you.
Okay, even better. So if you were the general manager, how would you evaluate? Would you pay $5 million a year for LeBron James or $20 million a year? How do you make that decision?
Romier.
Well, I guess, of course, a major component is their skill level and exactly how good they are at the game and whether they can ultimately win the championship. But another thing that's also important to measure is how much revenue are they bringing the franchise itself, which names generate the most clicks. Like I know LeBron is obviously a very good example, but then you also have someone along the likes of Stephen Curry and stuff, which are big names that attract an audience, which is also good for the franchise itself.
Great points. Other comments, other thoughts?
John.
I would simply look at the analytics and pay for the wins above replacement, or the WAR, as they refer to in the NBA. Don't have to worry about their personality or anything. If they're good, they'll win championships, and that's how they will become mainstream and drive revenue.
Yeah, so that growth of the Moneyball principles and the analytics being put in basketball has been a complete game changer in how you evaluate players. Any other thoughts from anyone?
Eliana.
Thank you. I would, of course, consider past statistics, how much other teams paid for the traded player, but then also consider, once again, the intrinsic and extrinsic values. So based on his statistics,
Mm.
how well is he playing? How many, assists? Yeah, free throws and stuff, all that. And then also consider the intrinsic value. So like a company, brand name, and all of that stuff. What is he the face of, and what does he represent, and how will buyers like to see that?
Wonderful, wonderful. So I love that intrinsic and extrinsic value. So I think the takeaway is there's a lot of factors that we would factor in here. So here's a couple that I just thought of, and I think you guys probably know basketball and sports even better than I do. Scoring potential, passing potential, fit within the team, defense potential, speed, height, strength, rebounding ability. And then some of those intrinsic values, is he a team player, leadership, character, ethics? Some are easily quantifiable, others are hard to quantify. And then the easiest thing to quantify is that end price. So that is very well known. So if we were to simplify it into categories, you would say a player has offense and defense and intangibles and a price of a contract. So I sort of put it in my mind into 4 buckets. Do you need defensive talent like a Dennis Rodman? Do you need a rebounder? Do you need a shooter on your team? Do you need a leader on your team? And then what's your price? How does it fit together in the overall team? This, believe it or not, is very similar to managing a portfolio, of having companies with offense, companies with defense, companies with intangibles, how they fit together in your portfolio. And basically you want to maximize all the different areas. So just quickly, and I can send these slides out as well. This is sort of a secret sauce of ours, is we look at the growth of the business, which I would call the offense. We look at the quality of the business, which I would call the defense, the sustainability. We look at the intangibles of a business, so the management, the culture, the ESG factors. And then we look at the value of what we're paying for it, price to earnings ratio, dividend yield. I put even below what the market averages over the long term are for these factors. So, growth on average, companies will grow 6 to 8% per year. Quality, you'll get about a 15% return on equity. Average, decent management and intangibles. And then on average, you pay 17 times price to earnings ratio of the market. So how can you beat the market or generate, exceptional returns? Like we said, if you want different returns, you have to do something differently. What you'll look to do is maximize certain one of these qualities. So if you want a team that needs a shooter, needs offense, then you'll really look to maximize offense. And, if you were to have Amazon, if you were to put Amazon up here, for example, their PE ratio would be high, so you'd be paying high value, but the ESG and intangibles would be very high because Jeff Bezos and the culture of Amazon is very high. The quality would be very high, and the growth would also be exceptional. So there you're balancing, okay, I'm fine to pay a little more because I'm getting growth, quality, and intangibles. So this is a way that you can put in a framework of where is this expected to do better than market averages. So yeah, just to skip quickly through these slides, these are some screens, and I can send these slides. Some of you have these, but these are some of our favorite screens that we look for. Potential sources of edge, time horizon, in-depth knowledge, temperament, second level thinking. All of these can be your edge in finding stocks. Time horizon arbitrage we talk about. I want to get to these last 2 slides because I think you'll find them interesting. So here are investment adages that we always keep in mind when we're investing in stocks. And these are investment truths that have stood the test of time. So, Warren Buffett, be fearful when others are greedy, be greedy when others are fearful. Don't water your weeds and trim your flowers, which basically means when you have a great company that you found, You don't need to keep trimming it. The best thing to do is just let it run. When you have an Amazon, just let it run and don't water your weeds. If it's a, you know, if you made a mistake, the best thing to do is to let it go. At the same time, trees can't grow to the sky. So a company can't grow forever. There's always a limit. There's no substitute for doing your own homework. Invest in what you know. I love this by Warren Buffett. When a manager with a reputation for brilliance tackles a business with a reputation for bad economics, the reputation of the business remains intact. So it's very tough to make a bad business good. Don't follow the herd, invest with a margin of safety. Good companies make good investments. We know these from the 7 golden rules. It's better to buy a wonderful company at a fair price than a fair company at a wonderful price. 90% of your work is done upfront before investing. You can fall in love with a company, but you can't fall in love with a stock. Don't try to catch a falling knife, which means if a stock is falling, don't try and catch it. They call that a falling knife. It's better to be approximately right than precisely wrong. I love this because so much of investing is the art of investing rather than the exact science. Let your winners run. Watch the incentives of management and board structures. The 4 most dangerous words in investing are, it's different this time. Why diversification, as Warren Buffett said, is only required when investors do not understand what they're doing. Risk is not volatility, it's permanent loss of capital. So don't be afraid of volatility. It's actually your friend as a long-term investor. And then the last one, rarely do 3 or 4 variables really count. Everything else is just noise. So those are some lessons to keep in mind. And then this last slide is this is sort of my cheat sheet that I am revealing to you as sort of my secret sauce. So the key to investing, just like that quote of the reputation of the business is what weighs out in the end, is to fish where the fishes are, and you'll catch a lot more fish. And so what we do as investors is basically analyze business models and find business models that are unique, exceptional, easy to predict, and can generate great long-term growth and returns. And once we find these business models, I'll tell you my secret is, what I do is I go find these business models in different countries. So, you know, Google's a great business, search, you know, internet search is a powerful business. And then you go find the Googles of Russia, which is Yandex, the Google of China, which is Baidu. And lo and behold, these turn out to be great businesses over the long run. Internet classifieds like eBay and Craigslist, very powerful network effect businesses. We just go find those businesses in other markets, and lo and behold, the same trends play out there. So this is my cheat sheet to all of you of, after nearly 20 years of investing, these are the sectors that we feel very comfortable are where a lot of fish are for long-term winners. So you can take notes of this page. There's lots of great businesses on here. You can study these sectors. I'm sure there's a lot more great sectors, but one of the keys to investing is to stay in your circle of competence, to invest in what you know, and so create your circle of competence over time. For me, this is my circle of competence over 20 years, and these are sort of proven business models that we can generate great long-term returns in these businesses. So you'll find a lot of these elevators, branded paint businesses, pet food, medical devices, data centers, SaaS software, e-commerce, consumer goods, hardware improvement, retail, and follow the business, and then you'll find the great stocks and companies after that. So those were my thoughts. I would love to open it up to questions if anyone has it. Eliana, I think you're on mute.
Okay, thank you. I wanted to ask kind of how you pick those niches. Is that mainly just your expertise and that you know you're comfortable within those categories? Or have you learned from other people about this kind of category or niche is really taking off and you should look at it?
Yeah, so a lot of it is learning from other investors. So it's reading books, it's reading for what sectors. As an investor, I love investing, and whether all of you go into investing as a career or whether you just do it for fun with your own individual accounts, investing is the study of business, and really the study of business is the study of everything that happens in the world, economics, psychology, everything. And so as you're a student of businesses and industries, you learn and you read what are the successful ones. So when I shared that list, I'm sure it wasn't groundbreaking to a lot of you. I'm sure you were saying, of course, Mr. Fletcher, like, you know, e-commerce is a great business and Google's a great business. And, you know, of course, but understanding the factors of what makes those businesses great. One of the best ways I love to invest is when you find a dominant champion like Jeff talked about, and they have created a network effect and their market share is now 60%. And that flywheel is starting to turn so much that there's no doubt that they will continue to grow market share. And there's sort of no doubt that that segment will continue to take share. So like e-commerce is taking share away from brick or mortar. Amazon is the dominant leader. Those are not Herculean assumptions. Those are very easy assumptions to make. And the more predictable and confident you can become in those assumptions, the more often you'll get it right. And that's led to a lot of our investment success, is really sticking where you feel very confident on those assumptions and that business model. It's a good question, Ileana.
All right, I also have Jack who has a question for you.
Yeah, so I just wanted to say thank you for organizing this, and I'm shocked that I got to hear from all those like incredibly intelligent and successful people.
Amazing, huh?
And I noticed that, you know, they went to colleges like Harvard and Stanford and UCLA and other colleges that are, you know, very, very esteemed. And I'm a junior, so I'm in the process of applying to colleges. And of course, you know, I'm trying to get into the best colleges I can. But there are also, you know, lots of like pretty good colleges, but not like Ivy League colleges that I love. So I was wondering how important you think it is that we go to, you know, the most prominent colleges in America and the world, and how like employers and just our education will be affected by that.
Yeah, it's a great question. The general advice I would give is invest in education. So invest in knowledge and education during these next 5 or 10 years of your life. Everyone on this call is taking a Friday night and learning about investing in Young Investors Society, and you're already investing in your education. You know, earning the CYIA designation, earning the CFA Foundation's investment program certificate, getting into the best college and going and doing your best, earning the CFA before peers if you want to go into finance, earning those certifications. This next decade for you, Jack, is the time for you to invest in knowledge and education. And so it doesn't mean that you have to go to an Ivy League school, but it does mean that I think Greg's point was such a good one, is the winners keep winning. And the reason that the winners keep winning is because they keep investing in themselves. And I think all of you are on such a great track to invest in yourselves. Yeah, I would also say reach out to mentors, reach out to networks, and there are lots of people out there that want to invest in you as well. So with letters of recommendation, with advice, don't feel shy to reach out to those around you to help you. But it's a good question, and I have no doubt that all of you will do very well. And as you know, as many of you know, I am personally happy to write any of you, especially on the student advisory board, or that I know, a letter of recommendation for college if it will help you. And we've had a lot of people actually get into the Ivy League schools from Young Investors Society leadership experience.
Great, James. I have Pranay who wants to know, when you're researching companies, how many indicators and metrics do you look at for it to be in agreement with each other? And how do you block out other unnecessary noise?
Yeah, great question, Pranay. So if I shared my financial model with you, our template, I would have hundreds of financial ratios and assumptions, 20 tabs modeling all of their business segments. And so you're aware of all of the ratios. At the same time, I am a firm believer of that last statement I said. It's almost always 3 or 4 points that make all the difference. You could have done all of the analyzing of Amazon.com you wanted to 15 years ago. But if you just knew a couple things and got them right, that e-commerce was going to go to 20% of sales, that Jeff Bezos had this remarkable culture of customer first and learning and productivity, and that they had the infrastructure to grow it, that would have probably got you to these astronomical gains in Amazon.com. And you could have analyzed all of the financial ratios you wanted, but just knowing those 3 things would have got you there with Amazon.com. But it's finding what those 3 things are. And that's why I say, understand your circle of confidence and understand certain industries so that you know what are the key 3 or 4 things that are going to make all of the difference for this sector and this business and this stock.
Great. Does anyone have anything else for James?
I think John O'Neill had his hand up.
Let's see. John, did you have
John,
something?
you still have a question?
No, sorry, that was from the MBA question.
Okay, good. Any other questions from the group? We've gone slightly over time. All right, it looks like
one last one from Manar.
Yeah, thank you. First, I just wanna just like the rest, I wanted to thank you so much for organizing such an event. And my question is related to diversifying your portfolio. So when you diversify your portfolio, like how can you avoid like picking companies or companies that are gonna try to avoid companies that might harm like some other companies that you have picked in order to diversify your portfolio, if you get what I'm saying.
Yeah, so if companies compete with each other or one may do better at the expense of the other. That's a good question, Manar. Yeah, I put up the slide about LeBron James, or I put up that, that topic so that you would feel that there's a reason for offense in the portfolio. Just like a sports team, you need scoring, but you also need defense, and you also need rebounding, and you also need leadership and intangibles and some of those other aspects. And you also need sort of a fair price in your salary cap. Portfolio is the same way. So there will be companies that will be growth companies, and those will be maybe attack companies, and they may be disrupting the business of your defensive companies. And that's okay. You want to manage a portfolio that has different exposures. If you own Amazon.com and you own Walmart in your portfolio, Amazon may be taking share away from Walmart, but Walmart may be a more consistent cash generator, have more dividends, and so may protect you at the right time in the cycle. So in general, you want a portfolio of companies that you believe in, but at the same time, it is very helpful to think in terms of offense, defense, intangibles, and value. And having hedging properties in a portfolio is a good thing. So having some companies that do well when the dollar weakens and other companies that get hurt when the dollar weakens, that's always a really nice hedge to have in your investment portfolio. So good question. Okay, I have one final trivia question. And so we'll do our last stockpile giveaway, and then we will call it a night. And let me just open it back up. Okay, so this last one, let's, oh, sorry, I need to, sometimes PowerPoint loads as a sharing function and other times it doesn't. Let's see here. All right. Last, and we just have one more trivia question. So we've done a good amount of these. All right, ready. Charlie Munger, Warren Buffett's longtime partner, was born in what city? This is our last question of the day. We'll end on a favorite, which is Warren Buffett and Charlie Munger. Charlie Munger is actually started out as a lawyer, but was a great investor on the side, and Warren Buffett roped him in to joining him at Berkshire Hathaway. Okay, so this is a bit of a tricky one. So those who said LA were that's a logical answer, and I almost would have said LA as well, because Charlie Munger lives in LA today and has lived in LA for a long time. So Warren Buffett and Charlie Munger have been halfway across the country for most of their career. The correct answer, though, is Omaha, Nebraska, where Warren Buffett is from. So Jack Swisher was the first to write Omaha. So this was, Charlie Munger actually worked in the hardware store in Omaha for Warren Buffett's grandfather. And so they knew each other as kids, and they sort of stayed in contact over the years. So Charlie Munger was also from Omaha, Nebraska, but had moved out to LA, and that's where he's resided for the past 50 years. So great answer, Omaha, Nebraska. Okay, so with that concludes the first Young Investors Society Global Investment Symposium. Thank you for participating. Hope you all had a great experience. I think our speakers were phenomenal. I think Greg, Grace, David, and Jeff were just amazing presenters. I hope you appreciate how experienced they are in their segments, and how generous it was for them to give of their time. But they did it because they believe in you, and because they want to help you, the next generation. So thank you for your time, and this has been a wonderful event. And we'll talk to you soon.
Bye, guys.
Bye, everyone.